Welcome to Pro News Weekly. Let's dive into the latest updates from the financial markets. The US dollar continues its advance, equities are undergoing a correction, gold is losing the battle for trend, and Bitcoin's rally has faltered. Rising oil prices and the Fed's hawkish rhetoric have continued to support the US dollar's advance. Escalating geopolitical tensions in the Middle East have caused significant disruption to energy infrastructure in the region, sending Brent crude surging above $112 a barrel and weighing heavily on Euro-USD. The sharp spike in oil prices is adding pressure to an already complex macroeconomic environment, with policymakers and markets closely watching how the situation develops and what it means for inflation, energy supply, and global growth. Within the FOMC, even officials who had previously advocated for rate cuts have reconsidered. The latest median estimate points to just a single rate cut in 2026, broadly in line with current market pricing. With energy prices surging and uncertainty showing no signs of easing, investors are increasingly questioning whether any monetary easing will materialize at all. The Fed now finds itself navigating a challenging combination of pressures, including trade tensions, the lingering effects of the pandemic, and a fresh energy shock, all of which risk keeping inflationary expectations elevated for longer. The FOMC's upward revision of its forecast for the personal consumption expenditure price growth from 2.4% to 2.7% year over year suggests that the Fed is more likely to keep rates on hold than to cut them. So, the US dollar is currently a relatively high-yield currency, and the longer borrowing costs remain at current levels, the more comfortable the Euro-USD bears feel. The escalation of the conflict in the Middle East, the acceleration in producer prices in December, and the Fed's intention to keep rates high for a long time are forcing US stock indices into a correction. This combination of factors paints a stagflationary picture for the US economy, which is bad for shares. Now, usually when we see this kind of uncertainty, broad stock indices tend to sell off quite quickly. But US stocks have been surprisingly resilient. Yes, the VIX Fear Index did spike above 35 in the early days of the conflict, but volatility has since pulled back to February levels, with only a slight uptick more recently. Nevertheless, the Bank of America survey showed asset managers' optimism regarding U.S. equities has slipped to a 6-month low. Institutional investors are increasing the proportion of cash in their portfolios and cutting their economic forecasts. They cite geopolitics and inflation as the main risks and are less concerned about an artificial intelligence bubble. For a long time, gold clung to the $5,000 per ounce level, in the hope that the Fed would discourage the markets from expecting an extended pause in the cycle of monetary expansion. However, Jerome Powell stated that markets should not expect a rate cut until the Fed is confident that inflation is slowing. This triggered a wave of selling in gold. With rising crude oil prices, consumer prices are more likely to accelerate than to fall. In theory, scary geopolitics should support gold. However, there are rumors in the market that the precious metal has become a speculative asset. Indeed, the rally in metals to record highs in January was driven by FOMO rather than fundamentals. The decline in gold prices risks deepening. However, in the medium term, the negative economic impact of the oil crisis on developed markets will force central banks to deploy monetary easing, which should support commodities. Bitcoin has been something of a bright spot so far this month, actually outperforming both gold and stock indices. But the ongoing attacks on Middle Eastern energy infrastructure, combined with the Fed's clear intention to keep interest rates higher for longer, have started to weigh on it as well. The cost of cryptocurrency mining increases as the Brent price nears $120, and gas prices rise as well. As a result, the supply of tokens rises to cover these costs. At the same time, the Fed and other central banks keeping interest rates high acts as a headwind for risky assets. Bitcoin is being supported by capital inflows into ETFs. Over the 5 days to the 13th of March, holdings in specialized exchange-traded funds rose by $750 million, marking the third consecutive week of inflows. However, these flows often follow prices rather than driving them. Therefore, a fall in Bitcoin could change the situation. Data releases on European and US business activity, as well as inflation figures from Japan, Australia, and the UK, will be the key events on the economic calendar for the final full week of March. Investors will be looking for signs of an economic slowdown and rising consumer prices to assess the risks of stagflation. Central banks keeping interest rates high play in favor of high-yielding currencies. Rising oil prices due to the conflict in the Middle East are helping the currencies of exporting nations. All of this is characteristic of the US dollar, whose rally is set to continue for a fourth week. Until geopolitical risks ease, stock indices and Bitcoin will be unable to recover. Investors will be closely monitoring the White House's legal action against Jerome Powell and the process of appointing Kevin Warsh as Fed chair. Until Congress approves this nomination, the markets will not believe in an imminent cut to the federal funds rate. Keep up to date with global market developments in Pro News Weekly. Like, share, and subscribe.